Very good evening to you all, friends. I am Sanjeev Singhal, Central Council member and Chairman Auditing and Assurance Standard Board. I welcome you all to the new financial year 24-25. And I know this is very busy season, busy season for the audit of the listed companies. And keeping in mind that thing that you all will be busy in the audit of listed company, you will have many queries. And for that, we are bringing this series of the webinars. And hats off to our speakers and moderators who have taken out time during this busy season. If I have to talk about Amit Mitra, Amit is a very senior partner in MSKA, and Praveen Kumarji. Again, he is the assurance head. In fact, Amit is also the assurance head, and Praveen Kumarji is also the assurance head. Praveenji is assurance head in ASA, and two of our young moderators, Deepak Goyal and Ayush Mittal. So all four of them have taken out time. And in fact, we'll be doing about 6 to 7 programs this series. So about 24 of our very esteemed members will be taking out time so that you stay updated and the best of the audit quality is delivered. Friends, it is 96th program of AASB in this council year. It is less than 96 days. In fact, it is less than 48 days that AASB for this year has been formed, and it is our 96th program, out of which 82 has been on bank audits, maybe 82 or 83, 84. And rest have been, on the various topics. In fact, Praveen Kumarji has traveled extensively with me in many of the branches and taken the programs on the bank audit, talking about the documentation. The program is taken in Delhi and some parts of Punjab. So kudos to the dedication that they have. And friends, like every year, we have one expert panel running, which is on answering the bank branch audit queries. And this year, this will function from 1st April to 30th of April instead of 15th of April. So 1st April to 30th of April, if you have any queries while doing the bank branch audits which pertain to that bank branch audit, please feel free to ask, and it is our endeavor to revert within 24 to 48 hours. And similarly, we have constituted a panel for answering your queries on statutory audits of the corporate as well as non-corporate sector. And this will function from 16th April to 30th September. And again, for both, we have 50-50 experts, and some of them are common. Like I know that Praveen Kumarji is an expert in bank audit panel also, as well as in the statutory audit panel. So it's really remarkable that how much time our members devote for the benefit of the other fellow members. So salute to their this feeling of the brotherhoodness, and also keeping the flag of the profession high. Both are very esteemed friend of mine, and they have been special invitee for many years now in the auditing and assurance standard board. And Praveen Kumarji has also been a special invitee at NACAS, and same goes with Amit Mitra, that both have been contributing to so many publications, technical publications of the institute, not only in AASB but beyond AASB as well. And Deepak has worked extensively in industry, and similarly for Ayush. And both of them agreed to be the moderator. Being moderator is a first step towards becoming a speaker. There is a limited role that we assign to the moderator, and more extensive role to the speakers. Today's topic, friends, and it is the first webinar in this series of webinar. This is LODR requirement. Since I said that this is for the listed companies, so what are the listing obligation disclosure requirement? Two of our learned friends will be talking about the same, and Ayush and Deepak will be posing queries to them that they will receive from our esteemed members. And then we have more in this series coming. Next is Karo, wherein one of our past president, very esteemed past president, Amarjit Chopra ji, will also be one of the speaker. And then we have on Schedule 3, and similarly we have planned different topics to give you an overview. And once this series is over, once the listed company audit season is over, then we'll come up with the unlisted company season also through these webinars. So once again, I thank all the esteemed panelists and moderator and Anil Lalji. Organizing 96 programs is not easy, friends. So much of logistics is required. So thank you, Anilji, for being there, and of course, Vishal Bhai, who is the vice chairman, and always standing with me. So I'm really grateful to all of you, and I now invite Ayush Mittal to kindly take it further. Thank you.
Thank you, CA Dr. Sanjeev Singhal, sir, for giving us and our fellow audience this opportunity to be a part of this webinar on key considerations in audit of listed companies, as well as LODR requirements in case of listed companies. Sir, currently the chairman of AASB of ICI, we extend our heartfelt thanks to you. Also, I would like to thank CA Vishal Doshi, sir, the Vice Chairman of AASB of ICI, in his absentia. Today, we are having with us two very prominent and eminent speakers, CA Praveen Kumar, sir, and CA Amit Mitra, sir. I would like to introduce our speaker, CA Praveen Kumar, sir. Sir is the Senior Partner and National Head of Assurance Division of ASA. With over 33 years of post-qualification experience, Sir is a commerce graduate and holds a diploma in information systems audit, besides certification in IFRS from UK and holding certification in forensic audits. Sir is a member of AASB. Earlier, Sir was a member of NACAS, Accounting Standard Boards, and various expert advisory committees, besides various research groups and committees of Indian CA Institute. Sir is having experience of working on large number of audits, forensic audits, fraud investigations, and IFRS transitions for various corporates. Sir, CA Praveen sir was also a speaker at national and international forums on his subjects of expertise. Sir has been a faculty with reputed institutes like IMT, NAAA, ICAI, ICSI, ICWAI, CAG, NIFM, MCA, and Delhi University. Sir's book has been published by CCH and Sir has written many papers and articles for renowned journals and magazines. Sir has also been invited to present a paper by reputed institutions all over the world, including Japan, Nepal, Myanmar, Dubai, Singapore, besides various large companies and branches of ICI across the country. Now I would like my fellow moderator, CA Deepak Goyal, to introduce Amit Mitra, sir.
Deepak bhai, unmute karo.
Thank you, Ayush. Thank you, Dr. Sanjeev sir, Chairman ASB and Vice Chairman Vishal Doshi sir, to give opportunity as a moderator. I also thank our participants. LODR is the very interesting topic. I will just introduce our speaker, Amit Mitraji. Sir is a senior partner with MSK and Associates, has over 24 years of rich experience in audit and accounting services to domestic and international clients. And academic speakers in various forms, he possesses rich exposures of IFRS, a lead partner on several listed and large multinational engagements. He has excellent exposure in the implementation of internal financial control frameworks. He is a joint leader of professional practice group of the firm, and he had audit and assurance quality management for the India firm. He is special invited to the Audit Assurance Standards Board since 2019, part of subcommittee working on SQM1 and SQM2. He is also peer reviewer and he is a technical reviewer, contributing to the FRRB of the ICI. I welcome Amit sir for this webinar to start his session.
Thank you. Am I audible?
Yes, sir.
Okay, so thank you, AASB Chairman Sir Sandeep sir, Anil Deepak, Ayush, and Good afternoon to all my friends. And before I put on my slides, I have to put this on record that I am today highly privileged and honored to share this virtual dais with my senior professional member, CA Praveen Kumarji. Praveen Kumarji, thank you, sir. Thank you for sharing this virtual dais with me. I'm truly honored. I will now put up my slide. Anilji, is the screen visible?
Yes, sir. Yes, sir. Yes, sir. Yes, sir.
Okay, great. Okay, so in this presentation, we will delve a little bit into the critical considerations in the auditing of the listed entities, with a particular emphasis on LODR requirement as mandated by regulatory authorities. Now, of course, the idea is not to run a course here where we go step by step, or we go subsection by section. Right? The idea is, because my assumption is that all of us are already well versed with that, but there have been significant changes in last 12 months or so, which are applicable to us as auditors, and to the audit committees, and to the independent directors. And there have been a lot of disclosures requirement which the companies are now mandated to do. So I think as professionals from both the sides, from the auditing side and from the industry side, we ought to be aware of that, because the idea is not, as a chartered accountant, the idea is not to err on the wrong side of the law. And of course, it is gaining significant importance from the regulators' perspective, from the SEBI's perspective. And I was privileged enough to attend this CII event where chairperson of SEBI was there, and then she shared some startling facts about how the economy is growing and how the Indian stock exchange is growing, and yet in spite of so high valuations, and then she quoted certain numbers. I will just touch upon that. Basically, the idea is to kind of put forth the fact that there is this regulatory body, there is this stock exchange, there are other stakeholders, and then there are the watchdogs like us. Everyone has a role to play, and everyone is contributing for the economy to grow, for the country to grow. If you look at some stats, I mean, she said that 44% of the holdings is of the holdings of the entire companies listed on the stock exchange, which are around 5,200. So about 5,200 companies are listed on Bombay Stock Exchange, and about National Stock Exchange, which is about 3,300 types. So if we take a total sum of all these companies, about 44% is held by the promoter groups, which means 56% of the equity is held by the retail investors plus the mutual funds. So we as the watchdogs, we as the custodian of ensuring that the books look right, they are representative in a way. We are representative of this 56% of this large population, and so we hold a significant importance there. And so what are these changes all about? I mean, we've been kind of dwelling. So I think the bottom line, which the regulators have in suggesting new amendments or new changes, is based on the fact that they want to increase the trust. And how does the trust increase? The trust will increase if we increase the transparency. If we increase the transparency and if we do a fair job, this is what is needed. So regulators are kind of basis in hindsight, basis on certain incidents that have taken place. Their objective is to increase the transparency, increase the disclosures. And how do you do that? You do that by opening up by showing in more disclosures. Okay, now. So I think the topics for today, as I said, the idea is really not to dwell upon each and every section. The idea is to take you through on certain important changes, let's say which have taken place during the year. Regulation 30 and Regulation 23 of the LODR, those have undergone significant changes. Of course, there are many others also in the applicables. In few cases, the applicability for the circular date was June of 2023. There was July of 2023. But I guess I'm not really going into that. I just want to focus more on these two regulations, 30 and 23. 23 is on the related party, and 30 is on the disclosures and the materialities, all those aspects. There are some other relevant topics also which I intend to take up, which audit trail is of course applicable for listed as well as non-listed entities. But I just thought this is extremely important for us because this is the talk of the town. It has an impact on the. It may have an impact on the auditor's report depending on what kind of audit trail is prevalent and auditable by us. Then the related party, the definition of related party has undergone a sea change from SEBI perspective, from disclosure perspective. I'll just touch upon that also. And then material accounting policies information. Now, of course, this again, any entity which is covered under the Ind AS regime. For all the listed entities are covered under Ind AS regime. I just want to touch upon that. I thought that this is extremely important for us to be aware of before we kick off this new year with the new regulation. NOCLAR. NOCLAR is an animal which is applicable for the listed entities. This got triggered from, I think we have already done 1 year. We got triggered in October of 2022. But still, if we talk in the communities, there is not enough clarity as to what additional, because there was this SA 250 already in the system, and then they thought that in any case, auditors are required to comment on the laws and regulations. So what is new in NOCLAR? Of course, had there not been any regulations on the NOCLAR side, I don't think much would have changed. But with NOCLAR, there are certain written responsibilities cast on the auditors, especially on the listed company auditors, to report on certain non-compliances. UPSI. Now, of late, we have seen that with the digitization coming in, where there is so much of linkage between the equity shares that we purchase in the market and the demat account and the CAMs, and then the data flowing from the trail of the data is visible and flows from one account to another account to the stock exchange. Today, the regulators, on a click of a button, have significant amount of information which they can use or which they are using to ensure that we are complying with. And UPSI is, of course, the auditors are one of the parties who have this price-sensitive information and are covered in the ambit of the compliance of the UPSI. So it is important for us to understand the UPSI and compliance for that, and so is the structured digital database, which is required to be demonstrated if we as the auditor receive any inquiry from a UPSI perspective. And then maybe a small, maybe 30 seconds discussion on the key audit matters. I know this is a very, very old matter, but 2 or 3 messages which I would want to give, probably, which have also kind of flown through the NFRA orders, wherein a few auditors have tried to disguise the audit qualification in the form of a key audit matter, which is, of course, not the intention of the law and not the intention of the auditing standards. Okay. While we'll go through some key amendments now, from the auditor's perspective, the important thing is to ensure the compliance and the reporting accordingly. From a change perspective, for the Schedule 3, Part A, Para A, which talked about the mandatory disclosure. Now, disclosures have been defined clearly, identified in the circulars. Like, for example, these would be the cases for mandatory circulars, and there have been Part A, Para B, which basically talks about disclosure based on qualitative aspect and the quantitative aspects, and how is materiality to be determined. Again, the bottom line clearly is to ensure consistency across the board, and so there has to be some benchmark. I mean, someone thinks that this is material, this is not material. So, and this is certain past precedents. The regulator thought that it is up to them to clearly identify as to what is a mandatory disclosure. And of course, I really can't go into the entire list. It is a very, very long list. It is available on the SEBI website, available on various forums, various internet document. But basic idea is to give you that there is this change, there is this amendment which talks about a mandatory disclosure required by the companies and the company secretary within those companies, the compliance officers are required to know. There have been on the quantitative basis of materiality, it basically covered certain sections like or sections or events or information where if this information is not submitted, the omission of an event or information, where it is likely to result is a discontinuity or alteration of events or information already available in the public domain. If it is already available and the discontinuity of such information will have an impact. Those are something which holds a qualitative aspect, irrespective of any grounds of materiality, needs to be disclosed. Then the next one is the omission of an event or information which is likely to result in a significant market reaction, upwards or downward both. And if the said omission came to light at a later date. Again, they've kind of this is completely open-ended, and then how do you demonstrate that because of this information there was no fluctuation? So one would need to identify at the beginning, and the compliance officers of the company secretary, the CFOs, and all the relevant people, they need to identify whether this information, if it comes to light later on, should not have any impact on market reaction. And the third one is the omission of an event or information whose value or the expected impact in terms of value exceeds the lower of the following, which is 2%. So they're basically trying to define the materiality. And then omission of an event or information, you quantify it and then you benchmark basis these three following criteria. The first one is the 2% of the turnover, which is of course as per the last audited balance sheet, and then 2% of the net worth as per the last audited consolidated balance sheet, except in a case where the arithmetic value of the net worth is nil. Of course, this is not applicable. Third one is 5% of the average absolute value of the profit or loss after tax. So when they say absolute, you mean what they're trying to say is that, let's say out of 3 years, in one of the years there is loss. So we need to take the absolute value. You can't really, let's say minus 20 and plus 80 and plus 80. So 160 minus 20, 140. So that's not what the intention is. They're saying you add 80 plus 20. That's how you need to calculate your material. And of course, 5% on that. So this is the way they're saying that you calculate the materiality, you then run it pass through your internal management and you get it blessed from the audit committees, and then based on this criteria, disclosures would be required. Okay. Now, certain mandatory disclosures, as you would see, if there is a acquisition or a sale based on the quantitative material threshold, if it is beyond the threshold given, then of course you need to disclose. It is required to disclose the acquisition. It could be sale or a disposal, and if the cost of acquisition or the price at which the shares are acquired or the amount of sale exceeds the quantitative materiality threshold. Now, this is something new. Of course, there were certain disclosures already prior to this change in the regulation 30, which talked about the disclosure of the acquisition and all. This basically talks about that acquisition needs to be disclosed where resulting out of a sale or disposal if the cost of acquisition. So irrespective of, they're trying to say that irrespective of anything, if the cost of acquisition or the price at which the shares are acquired or the amount of sale proceeds of quantitative materiality threshold beyond it exceeds that, then you disclose. Because companies were taking a call that this is not material and our materiality threshold is 10% and some said 4%, 5%, everyone had a different basis. Now we know how materiality is to be computed, and if it is beyond that, then it needs a mandatory disclosure. Next one is on the disclosure to include transaction where acquisition does not affect the shareholding of the company, but the cost of acquisition of the price at which the shares are acquired exceeds the specified material. So irrespective, the company used to do the transaction between two subsidiary companies or the subsidiary company with some other company where the holding company, which is a listed company, was not involved. They've come up with this criteria. And then, of course, if there is a change in the rating or if there have been new ratings, it is a mandatory disclosure. The next one is on the ESG. If there is a rating on the ESG, then that means also needs a disclosure. Now, the amendments now also requires the listed entities not only to disclose the frauds and defaults by the promoter, KMP, or the listed entity, but also those committed by, let's say, a director and the senior management in subsidiary of or a subsidiary of a listed company. So now they've widened the scope. They've added senior management also. And what is senior management? Of course, is defined. There have been cases one would need to get to know, so what this is. And director, of course, directors is other than the independent director. And then what is the default? They've defined what default would mean. So default generally would mean that where if the company is not able to make the payment of interest or principal amount fully as on the date when the debt has become due or payable, then it becomes a default. And if it is a default, then of course it needs disclosure. And then they've also clarified within the circular that how do you consider a case where there is a revolving facility like a cash credit. There it says an entity would be considered to be in default if the outstanding balance remains continuously in excess of the lower of the sanction limit or the drawing power for more than 30 days. Now, this 30 days is defined. And then the mandatory disclosure is required where there is arrest of a KMP or a senior management or a promoter or a director of a listed entity, whether occurred in India or abroad, that needs to be disclosed. Now, this is from the point of view of the company. And of course, from an auditor's perspective, I very briefly spoke about NOCLAR. If there are non-compliance, if the company is not disclosing, then when auditors, not all, few auditors, but taking a view that this is not impacting the true and fair, it is not impacting my P&L account, the company has created a provision in the books for the penalties, and also there's I have no need to modify my auditor's report. Now with NOCLAR coming in, it is expected that this should have some changes or some coloring in your auditor's report. It could be in the form of emphasis of matter, depending on a case to case. It could be if it is a very serious non-compliance. The stakeholders, from a stakeholder's perspective, I mean, they would expect a modification in the form of a qualification also. That depends. But from auditor's perspective, non-compliance is a non-compliance. To NOCLAR, it needs to be treated accordingly. Okay. Moving on, some regulatory actions against the listed entities or its official. Now, this also needs a disclosure, of course, subject to some thresholds. Now, listed entities to provide details of actions initiated or orders passed by any regulatory authority, be it CBI, be it ED, EOW, or any statutory or enforcement authority, or the Reserve Bank of India, or any other regulatory authority, or MCA, or a judicial body. Now, this disclosure is required to be made irrespective of the quantum of fines or penalties. So one needs to really understand how do you define the actions initiated. Orders are, of course, speaking orders. The orders is not subjected to interpretation. What would really strictly get covered under the judicial bodies or the authorities or the statutory authorities, and also that a proper and adequate disclosure could be given. As it looks, it will be very, very difficult. It will be a highly judgmental call to not to disclose. I mean, if you're not disclosing, then one needs to ensure that why these matters have not been disclosed by the company. And if the company is not disclosed, then of course auditors have to ensure that they put it in their auditor's report on the non-compliances. Then listed entities to disclose the communication received from such an authority unless prohibited by the authorities themselves. Sometimes the matters are sensitive. Sometimes the matters are sensitive from the point of view of a country, and where the authorities themselves believe that this may jeopardize some. Um, if the matter is sub judice or if there's anything, they may say that please don't publish. If that is not the case, then it needs to be. Then the communication has to go to the authorities, which is SEBI. Therefore, communication received from any authority with respect to the regulatory actions are mandatorily required to be disclosed. So let's say, example, a suspension or an imposition of penalty or a settlement of proceedings or that needs disclosure. Okay, so um, some immediate responses, if you were to pen down, so one is that definition of the company needs to have the policy for the materiality, and that needs, and what has based the amendment, what has changed, and how do they interpret it? How do they, how does the management see it? How does the audit committee see it? How does the directors see it? And then also educating the directors and the independent directors on the new roles and compliances. Of course, one of the new roles is on the related party front, which I will cover in my subsequent slides. And then the identification of events that escape disclosures and have become material as per the revised criteria. What do you do on those cases? Of course, there is this cutoff that you would want to disclose and then you would want to discuss it and then take a call accordingly. And identification of agreements that those are binding on the listed entities, evaluating events prior to amendments but have continuing impact post amendment for reporting, and assessing the impact on subsidiaries disclosures and their agreement. Now, subsidiaries for suddenly for some reason, and of course all of us are aware because most of the outflow for the frauds have been through the related party transaction. Now, SEBI has really tightened the screws with the regulation 23 coming in, where they have reduced the threshold to such a low extent that it will mandate immediate disclosures by uh, the companies. Now, the new definition of related party basically covers any person or entity which forms part of the promoter or the promoter group. That is, no questions are that is deemed to be a related party. There have been many instances where definition of promoter group, sometimes they say this is not part of the related party. It's hard to believe, but there have been, kind of some corners within the law where you may have had that interpretation in the past. And also, no, any person holding 20% of equity share, any person holding 20%, it could be someone who's just acquiring shares in the company. He holds 20% of equity shares as of April 1, 2020, effective from April 1, 2022. Then this is 20%. Now from 1/4/2023, this threshold they have dropped down from 20 to 10%. And then for all the related party transactions, prior approval of audit committee is to be obtained, including subsequent material modifications. And if there is subsequent material modification, you need to go back to the audit committee and get it blessed. And for the related party transaction with subsidiaries of the listed entities exceeding 10% of the annual consolidated turnover of the related entity as of 1/4/2022, and it has again dropped down to 10% of annual standalone turnover for the subsidiary, which is effective from April 1, 2023. The subsidiary could be really, really insignificant. I mean, of course, there have been few subsidiaries would be material, and there in the corporate tree there will be many subsidiaries which are this immaterial, and 10% of the immaterial that also goes to the audit committee of the main consolidating company. It could be a holding company, the listed entity. I think we'll have to see how this concept goes, but it looks quite stringent to begin with. But however, if this is the rule of the land, that needs to be followed. And then transactions during the year exceeding 1,000 crore or 10% of the consolidated annual numbers, and entity whichever is lower as on 1/4/2022, and all such transactions would need prior approval of the shareholder. So you go to the shareholders now in this case. That's what is said. From April 1, 2023, prior approval of the audit committee of the listed entity is required for transaction to which subsidiary of a listed company is a party, but the listed entity is not a party. So let's say there has been transaction by the subsidiary and let's say a fellow subsidiary or some other entity where the related party, where the ultimate holding company or listed entity is not a party. In that situation, also please go back to the audit committee of the listed entity. If the value of such transactions were entered individually or together exceeds 10% of the annual standalone turnover. So everything has to be seen from a standalone level, at least the past the two instances that I mentioned. Again, the numbers have to be basis the last audited financial statement, not the current year that is being audited. Let's say for March 24, the last audited is 23. So basis the 23, the 10% threshold would be determined. This is the kind of detailing that has come up in Reg 23 and Reg 30. So, of course, the expected compliance from the companies and expected review by the auditors or audit by the auditors and documentation accordingly has to be quite robust. Again, some action points: determine the new related party that we discussed in previous 3-4 slides and the related party transactions as per the new definition. Of course, now we have now drilling it down to the subsidiary companies and transaction between subsidiary and outside the holding, but within group and all, and mapping of the existing related party transactions of the listed entity that identify instances of modifications of the condition. Then map those RPTs of subsidiary companies, and then of course set up an internal controls and processes to identify the overseas related party transactions and map the approval requirement, if any, within India and overseas. It's going to be a humongous task. It's not very simple. I mean, if anything is forming part of the audit committee of the listed entity, they would want to see what kind of controls does the holding company have, what kind of processes it is, how do we ensure that the information is complete, because there's a lot of onus now on the audit committee. So determining the additional disclosures in the determine the format, determine the frequency, determine how it's going to flow, and of course there could be training needs for the people to ensure that the adequate information is timely and adequate and complete. There could be some training needs from the independent director's perspective and how what should they really look at before approving the related party transaction. So it's a humongous task. Okay, so moving on to audit trail. Of course, this is applicable outside of the ambit of LODR and ambit of the listed entities. But I just thought it will be good to spend about a minute or so on this, because this is the talk of the town as we speak. Of course, two provisions, one for the companies and the other one for the auditors. Each is expected to perform their own responsibilities. From a company's perspective, the audit trail, and they will have to have a software that use a software where the audit trail of each and every transaction has to be recorded, identifiable, and seen. Then also they have to ensure that the software creates an edit log of each change made in the books of accounts along with the date when such change were made, and ensuring that this is not disabled. I mean, one is that this software has a feature and the other thing is that you've disabled it. So there's no point, right? And from the auditor's perspective, they have to ensure that this feature of recording the audit trail, which is the edit log facility, and the same has been operated throughout the year, and there has been implementation guide by the AASB ICAI. I think this is a very good document that gives a starting point for us as auditors to see what gets reported and how do we document, how do we define the books of accounts. Of course, that is debatable, but of course, it is important to have a starting point. Moving on, the audit trail feature has not been tampered with during the year. That audit trail feature was there, and it was kind of running throughout the year. It was not tampered, and the audit trail has been preserved by the company as per the statutory requirement for the report retention. And one thing it is really important to see that, of course, this is also a follow-up of certain incidents with the regulators have got, and then they put the onus on the company and also on the auditors to report upon. Globally, there is no such reporting obligation. We are yet to see that any Western world or the UKs and the US or the Europe, we've not seen any such kind of reporting by the auditors. I'll move on. This is basically is also applicable for Section 8 companies and foreign companies. There's no ambiguity there. It is quite clear. This is quite clarified. And now, what happens in a situation where the accounting is manual versus the software? The requirement of audit trail and audit log are applicable to the extent a company maintains its books of accounts and in the electronic form by using the accounting software. Thus, where the books of accounts are entirely maintained manually, the assessment and reporting responsibility, of course, will not be applicable. But I don't think there are any set of companies who may still be pursuing with manuals. Okay, so primarily from the auditor's responsibility perspective, the auditors are required to comment on whether the company is using the accounting software which has a feature of recording audit trail of each and every transaction. The auditor would be expected to verify the following: where that it is configured and it is not disabled, and it has been running throughout the year, and there have been it has not been tampered with. All the transactions are recorded and all the transactions are preserved. And now, what is books of accounts? That also needs to be defined in the documentation by the auditor, because what is not books of accounts, of course, that comes out of the ambit. So one needs to be very, very sure. So anything which is contributing to the financial statements which is, let's say, interface with softwares and all, has to form part of the books of accounts. Material accounting policy information. Now, this was a change in the IS1, Ind AS. Now, because the Ind AS is the accounting language for the listed entities, it is important for us. So, just given some thought here. What the change is that instead of significant accounting policies, the requirement is to now show all material accounting policies. So where it is obvious that what people used to do is that in the name of significant accounting policy, they just used to copy paste whatever is given in the standards without having much significance or meaning and relation with the financial statements. Now, what the mandate is that it is required to disclose only material accounting policies, and which, of course, will be far more useful, which will provide far more information and far more useful to the users of financial statement. Accounting policy is material if, when considered together with other information included in an entity's financial statements, it can reasonably expected to influence the decision. Now, this is important. So you have to. There's a professional judgment. If it is expected to influence the decision that the primary users of the general purpose financial will make on the basis of the financial statement. So let's say if there is a change in the discount rate used in some assessment, it could be going concern, it could be impairment. This would have a significant impact the way the users would really look at this. This needs to be disclosed. There could be many other examples also. So let's say if there's a change in the accounting policy. If the change in the accounting policy needs to be disclosed, surely it has to form part of a material accounting policy. This thing. Now, before the above amendments, some entities, which I think that I've already covered. Now, the rationale of introducing the amendment is to encourage the entities to provide entity-specific accounting policies and not disclose the standardized boilerplate information picked up directly from the auditing accounting standard, and information that only duplicates or summarizes the requirement of IFRS or India. So there is no meaning. One can always go to the books and see that. That's the intention. Now, the immaterial accounting policy information need not be disclosed. That's what is mentioned in the change. However, if it is disclosed, it should not obscure the material accounting policy information. For example, it has to be clearly defined in your notes to accounts that these are the material accounting policy. For example, an entity could obscure material accounting policy information by giving the immaterial accounting policies information having more prominence or presenting immaterial information with material information, such that the reader is unable to distinguish between the two. So this is not allowed. It will be noted that entity's conclusion that accounting policy information is immaterial does not affect the related disclosure requirement set out in the other Ind AS. So if Ind AS mandates, then of course disclosure is required. Okay, so NOCLAR. NOCLAR, and we've already done one financial year. This is the second financial year. So basically, the reiteration, but because it's applicable for listed entities, it touches the auditor's report. It touches primarily how the disclosures are to be made both by the management and by the auditors. I just thought it's really important to bring it in. Now, responsibilities of a professional is to obtain an understanding of the matter concerning the non-compliance and then discuss the matter with the appropriate level when we want to, beyond the management, when we want to go to TCWG also. And the light of response of the management and TCWG determine if further action is needed in the public interest and further action would be needed and disclose the matter as appropriate to an appropriate authority as specified under respective laws. If, let's say, for example, it's a matter relating to fraud and you wouldn't want to comply with 142, there are other matters which require some specific disclosure, then you want to disclose with regulators. Basically, it talks about that. Then appropriate disclosure should be maintained as per the Code of Ethics, the section 360. Now, withdrawing from, so let's say the management is not really kind of providing the necessary disclosures, and the auditors kind of one may want to. So in this situation, you may still want to reevaluate the professional relationship with the client, provided the law permits the auditor to move out of the engagement, which I don't think in case of listed entities it's possible anymore, because we have this resignation rules implementation guide, which talks about some block of 45 days block of after the reports are released, there's a window where the auditors can move. So this is kind of mandated for an auditor to issue the auditors. We wouldn't have that plugged into the disclosures and the modifications. Okay, so UPSI, of course, this is the part of SEBI investigation tool, and as I said in my beginning slide, because of the automation and because of the digitization, the information flow and the precise information is already available with our regulators. So for them, it just take a minute to get the confirmation from the officers. In case of UPSI generally would be people who have this price sensitive information, including the financial results, including information of dividend, change in the structure, merger, acquisition, and change in the key managerial persons and all. So from an auditor's perspective, and this is part of the independence and ethics, it is extremely important that the team working on the listed entities do comply very, very strictly on the UPSI, and the audit firm should have enough checks and balances and monitoring to ensure that the UPSI is complied with, not only in the form but in the mind also. Now, structured digital database, this is basically a database which the SEBI expects. This basically is a fallout of UPSI, and SEBI expect all the audit firms to maintain this kind of information, so that tomorrow, if there is anything, if there is any investigation or there is any need, one is able to extract this or ask this data from a structured digital database. Not many people are aware of this, but please go through the requirements of the UPSI and the maintenance of structured digital database. It needs to be available anytime, and it needs to be preserved for 8 years, which is kind of mandate for preserving the documentation. Key audit matters, of course, the message here is that this is not a substitute for expressing a modified opinion. also identified in one or two regulatory orders. This basically is to enhance the communicative value of the auditor's report and nothing more than that. And then also this, I mean, you can't really have too many key audit matters also. You need to apply professional judgment and then put in the most significant key audit matters in the auditor's report for the financial statements. Okay, now in conclusion, of course, we talked about independence and ethics. We talked about NOCLAR. I think it is extremely important that NOCLAR, if there is an issue, it should form part of your auditor's report of the listed entities. We talked about key audit matters. We talked about key audit matters. You really can't use them to modify your auditor's report. We talked about audit trail. Of course, audit trail is applicable for outside of the listed entities also. There are different set of requirements, one for the company and the other for the auditors. There is an implementation guide, which is a starting point. The basis that one would need to see the audit trail is there and it ran through the entire year. There is no breakage. It has been checkboxed as yet from a company's perspective. And then we also talked about the related party and the necessary disclosures, and then lowering the guard in terms of these thresholds for the related parties and then the disclosure requirements, the increased requirements from the audit committee perspective, and from auditor's perspective, they are not implementing in then through NOCLAR. You please put it in the auditor's report. UPSI we just talked about. Okay, that finishes my presentation. Anilji, over to you.
Thank you so much, sir.
Thank
Can
you.
you hear me?
Yes, sir.
Thank you so much.
Ayushi, please continue.
Yes, thank you so much, Amit sir, for your enlightenment on this topic of LODR for our fellow audience. It was truly very captivating and a very new topic for young chartereds and for the fellow audience. Thank you so much once again, sir.
Thank you.
I would now request CA Praveen Kumar sir to enlighten us with his knowledge, and our fellow audience can listen to sir on the topic. Please, sir.
Okay, thank you very much. So Amit Bhai very nicely explained what the key areas and key considerations. I was listening very carefully, and I think especially the related party transactions, they are going to have a lot of impact. And people who are working on geography related companies, large companies, they are going to have a tough time.
Absolutely, sir. Absolutely.
Yes.
Absolutely.
And also that audit trail, while anywhere in any other jurisdiction, this is not required. In India, there had been so much discussion about this. And even in our, other platforms also, we have been discussing and debating, including AASB.
That's right, sir. Yeah. Yeah.
So it's really very, very important aspect. So you brought out very nicely what all are key areas which now the auditors need to be very careful about. So Ayush, do you have any questions from the audience related to this session? Because Amit ji has to go somewhere. He has some commitment, but in case you have any question, he can answer.
So, sir, a few questions we have received from our fellow audience.
So you can, Amit ji, is it okay? Can he ask this question?
Yes. Yes, that's fine. That's fine.
So, sir, audience wants like few questions I would be presenting. So for penalty reporting, sir, is there any threshold limit which is prescribed?
No.
So no threshold limit for penalty.
No. So it's basically not very specifically penalty reporting. It basically talks about any, regulator giving a negative notice or something coming from a regulator which entails that if this information was not to be provided to the stock exchange may have an impact later on there. So penalty is basically a fallout of something which is a non-compliance. So if it is a fallout of something which is non-compliance, that needs to be disclosed. Of course, if this is something significantly immaterial, let's say I'm just thinking maybe an insider trading for 500 shares, and then penalty maybe the entire profit amount. Those kinds of call where it may not, it needs to be read in total. But otherwise, my understanding is if there's a high penalty and it may have an impact, it needs to be disclosed.
Got it. So one more question from the audience. If there is any related party transaction, sir, which is not approved by the audit committee, can it be approved by the company's board of directors?
Audit committee will have to bless it. There is no way out of it. They will have to. So there were certain provisions earlier. Omnibus approval was given, blanket approval, and certain facts. So the role of audit committee is different. The role of board of directors is different. The role of management is different, and auditors is different. It is not. It is not one or the other. It is defined in the law. It is defined in the act as to what audit committees are expected to do, what independent directors are expected to do. You can't do that. You can't, kind of instead of audit committee, boards can't approve.
So it doesn't just fall under the purview of board of directors. It is not in their purview.
The board may still want to approve, but they can't assume the role of audit committee. That's what I'm trying to say.
True. So one more question. Whether a company can switch over from revaluation model to cost model in case of landed properties? If yes, can it be? How can it be justified and disclosed, sir?
Okay, so this is something specific. I would refrain from answering because it depends on case to case and fact to fact. So the person can reach out to me separately. That would be a best forum. This is not the right forum for this.
I got it. I guess that's all from the audience.
Thank you.
Thank you, sir. Thank you for your time.
Sure. Thank you.
Praveen, sir, we can take over now.
Okay, thank you very much. After listening to Amit Bhai in a very crisp manner, let's look at some other aspect of audit of the listed companies. I'll try to share my screen. Let me know if it is visible. Ayush, is it visible?
Sir, it is visible. It is visible, sir.
All right. So my focus will be on when we are doing listed companies audit, what are the kind of documentation auditors are required to maintain. So that's the idea that, okay, you are in the month of April and the listed companies have already given you the dates. Okay, our audit committee will be on this date and our board will be on this date. So you are walking and you're planning, keeping your dates on a backward, that, okay, if the audit committee is going to happen on 10th of May, then probably you will need to have your things ready by 3rd of May. You will need to have a discussion with the CFO on basic issues 2 days before that. You may like to have a closure of your discussions with the process owners or with the accounts in charge on a particular date. You will have a discussion with the director of finance on this date. You will have a discussion with the joint auditors if you are a joint auditor. And then your team planning, your reviews, everything is being planned in such a manner. And in between, there is a webinar which you need to attend. This will talk about key consideration of, when you are doing audit of the listed companies. So Amit Bhai has clearly mentioned some of the key changes which are supposed to be taken care of. While doing the audit of listed companies, you have to keep in mind that this is a rule-based environment. There are a lot of guidance and instructions from SEBI, which the companies need to follow, as well as the auditors need to follow. Your audit documentation is something which is critical. Anybody, any regulator, whether it is SEBI or whether it is NAFRA or whether it is SFIO, whether it is CBI, Enforcement Directorate, or any other regulator, Income Tax Office, any regulator would like to see what kind of audit you have done. They will look into your audit file, work paper file. And also they will see what kind of reportings you have done. whether you have given a qualification, whether you have given emphasis of matter paragraph, whether you have given adverse report. So they will be looking into your reporting. So these are the key focus areas, when you are doing audit of the listed companies. So your regulation, a snapshot, LODR regulations number 33, it is applicable on equity listed companies, and regulation 52 is applicable on debt listed companies. So you will also need to understand that there is a compliance chart. So there is a requirement that Q1, Q2, Q3, and Q4, you will have to look into the P&L, the balance sheet, the cash flow statement, segment information, notes to accounts, everything you will have to do, and your timelines will be 60 days. Whereas in quarterly reporting, you will be doing limited reviews, and you will have 45 days. But now in this particular area, this time you will have 2 months time, 60 days to be precise. Now, when you are doing audit of listed companies, you will have to understand that there are disclosures. Amit Bhai has discussed in detail that there is a very big change. Your accounting policies, they need to be significant or material, and you will need to make a disclosure of material accounting policies. But your disclosures will include, in case there are any change in accounting policies, in case your opinion is modified, that means if you have given a qualification, and what is the impact of the same. In case there are exceptional items, you will have to mention that. You will have to be careful about seasonal variations, dividend paid or recommended during the year, including interim dividend. So when you were in accounting standard environment before Ind AS came, your client, the companies would make a provision and make a disclosure of dividends. But now the dividends are only when they are approved by the shareholders, then only have to be taken into account. Your disclosures should include, and they will include, the results of the last quarter in the financial year, and also aggregate effect of material adjustments, and also material events for the quarter end period. So anywhere where you are regrouping, reclassifying, please note that those things have to be explained, and those need to be detailed, and there is a disclosure required for that. Before moving further, and as Amit Bhai has mentioned, whatever we discuss in these sessions, these are our personal opinions, these are not to be taken as official literature of the institute. Any calls which you need to take, any professional call, you will have to refer to the official literature of the institute, which is accounting standards, auditing standards, guidance notes, or the literature which is there in the act or regulations. So we go to the next slide. Amit Bhai has also spoken about in prohibition of insider trading regulations. They are basically informations which are sensitive, price sensitive information. And what is the responsibility of the company? That the responsibility of company is to get all that, the basic, they have to prepare a list containing the name, email address, contact number, and also PAN card copy or any other, identification. And then this list will need to be prepared, and then you will need to, as a company, need to have a code of conduct to regulate, monitor, and report. Now the challenge comes when there are people who are outside India. Maybe they are doing some component audit, or they are doing some part, and they may not have their PAN number. The company may say that they need some other identity card or some other proof. So the challenge comes when when you're dealing with cross-border jurisdictions, Some of the jurisdiction may not have that kind of documentation, and people may hesitate in sharing their passport details or other details. So you will need to find out which are the best possible identity cards which can be kept in the records of the company, because as per the requirement of the law, the company will need to maintain the information that who are the people who are exposed to this unpublished price sensitive information. Now, when you are doing audit of the listed companies, there are certain restrictions, and these restrictions are coming from various directions. One is SEBI PIT regulations, which says that the people who are in this list, there are restrictions on having any transactions involving the shares of this company. Then Section 141 of the Companies Act. It prohibits people from holding any security, indebtedness, guarantee, providing guarantee or security or business relationship with the company in which you are an auditor. And also Code of Ethics requires the auditors to have no financial interest in this company. Now let's straight away come to the documentation part. Your speaking from a very broad perspective, you will have to, before accepting the audit, you will have to identify the risk, and then you will have to finalize what is your audit strategy. Keeping those risks in mind, you will need to identify which can be your focus areas, and your audit planning and your audit strategy should be in line with your thinking process. And in accordance with your audit plan, then your audit detailing will be and the field work will be carved out, and your reporting. So all this thread has to be well connected. So let us say if you have identified revenue as the fraud risk, your audit procedures need to be in line with what you have identified and what extra procedures you are required to do when you have identified that as a fraud risk. So your audit planning, your execution, and your reporting, your audit procedures, they have to be in line with the initial thought when you are strategizing on your audits. So your planning document should clearly demonstrate that you have understand the client and you have also understood the industry in which the client is operating. There can be unique situations in that particular industry. Like, for example, banking industry, there are very heavy regulations from the regulators. And in case of food processing companies, in case of insurance companies, there are different kind of regulations which are dominating that industry. So you need to understand the client and its industry, and it should be there in your file as a document that what have you understood, your audit planning memorandum. It should also mention about internal control procedures, internal control environment of the client, what kind of project management you are having, what is your planning, and then your assessment of risk, including fraud risk, and your analytical procedures, which are preliminary in the case, let's say you are doing audit of a listed company, the previous financial years and the trend of previous financials, and then your revenue, your expenses, your assets, your liabilities, they will, if you plot them in your files, or if you are using an analytical tool, they will throw up the trends, and they will tell you which areas you need to be focusing on. And all these need to be documented in your file. And then other inquiries, preliminary inquiries which you are doing from the management, they also need to be documented. So you have to ensure that your audit planning is integrated with the SEBI requirement, and all these have to be there in your planning file. If you are maintaining your audit documentation in soft form, then you have to ensure that these are being organized properly and have been stored properly. If you are doing it manual, then you'll have to ensure that your people who have looked into it, and then the maker and the checker, it should be clearly showing which person made this document and who was the reviewer. Later on during the slides, I will also discuss about the audit work paper. There's a checklist which has been issued by the institute. You can take help from that checklist, which talks about different standards on auditing and what kind of documentation you should be having. But it's very, very critical, especially in case of listed companies, because your work papers are going to be reviewed. They will be under scanner. There are regulators who will be looking into these documentations. So when you are making an inquiry from the management, you will need to understand what is that these inquiries are very, very important for understanding the business. And in terms of audit, it is essential to have a robust documentation. Just to give you an example, if you are having a meeting with the, let's say, the audit committee chairperson, you can always come back and you can write a small email and conveying your thanks. And these are the points which we had discussed. You made some inquiries, you can mention that this was what we asked and this is what you responded. At least you will have a document which will demonstrate that you carried out your audit procedures and you carried out what is required by the standards on auditing. You're using the expert, like for example, in case there is a external expert, there are some external experts which are being used and you have relied on their work. So basically, it's not sufficient to just have a report. Like for example, if you are auditing a company and they have made some employee benefit provisions as required by the standards, they may provide you some estimation and a report of the actuary. Now, it's not sufficient to just take that report and keep it in your file. It is also important to understand what were the assumptions and whether the person who has given that kind of calculation, whether you can rely on the expertise of that person or not. You can also look at the work papers and you can also challenge the basic assumptions and the estimates which were used in order to reach to the numbers which they are providing. Please remember, you as auditors are giving an opinion on those financial statements and the information which has been provided in those financial statements, whether that is giving true and fair picture or not. And any such work which has been done by the external expert, maybe evaluation, that might have a direct impact on the performance of the company, the numbers or the financial statement. So you need to be very sure about using the work of an expert. In recent orders, NAFRA has also raised questions on on the auditors, whether why they have not looked into the work of an expert in a proper manner. Then when you are doing audit of a listed company, there are significant management estimates. Standards on auditing F540, SA540 gives you very detailed guidance what exactly is required. Because this is one area which can directly and very significantly impact the numbers. So the data which has been given by the management or taken by the management as significant estimate, whether it is objectivity is in order, and assumptions which are used by the management are prudent. Whatever estimates, whether they have taken into account the complexities and whether independent estimation and comparisons are they are objective. So just to give you an example, in one of the case, there was a management estimate which was taken that okay, the salary increase for the employees will be at the range of in the range of 7%, and that is the estimate which the management had taken. 7% will be the salary increase, and then the gratuity and other calculations were done based on that assumption. But when it was challenged, and when people looked at when the auditor looked at the trend, they realized that none of the previous 5 years the management has given less than 15% raise in their salary. So taking an assumption of 7% was challenged, and the auditors could they could ask the management to change their assumption because this assumption was not prudent, or they wanted to have a little more explanation from the management. Why do you feel that for all these years you have been giving 15% plus increments, and this year you are anticipating only 7%? What are the reasons for that? Then SS 260 gives you guidance on communication with those charged with governance. And this is also one of the area where regulators have really asked the auditors questions about it. The board of directors or the audit committee, what kind of communication is being done by the auditors? There are a lot of questions on this particular aspect. And this SA 260 has been in limelight for so many reasons. There are various regulatory frameworks, like, for example, SEBI, LODR also. They mandate this communication from the auditors to the company and their board of directors, the audit committee. You need to have a robust documentation around this particular standard on auditing. So if you have gone and made a presentation to the audit committee, you feel that your work is done, probably not. You need to have much more interaction with the audit committee. You need to share with them what are your planning, how you are planning, and whatever you initially planned, whether your audit went alongside or in the same direction as it was earlier planned, or whether you had made any changes in your audit plan. So you have to communicate and also take views from those charged with governance. And you have to specifically ask in case there are any any regulatory reporting which has come to them, any communication which has come to them, any fraud which has been reported to them, so that they are also answerable in case they are trying to hide any information from the auditors. So you need to be very sure that your file demonstrate that you have communicated with the people who are charged with governance, and you have reached to the conclusion based on the inputs which you have received. Worth mentioning is that some of the auditors, what they do is they ask the company that give us minutes of the board meeting, and just they keep the minutes of the board meeting in their file. Tomorrow, if the regulator will come, we will show them that we have taken all the information from them. But merely keeping the minutes of the board meeting in your file is not sufficient. You need to understand what was discussed and what is the latest status of that. There may be a situation that there is a commitment there which might need a disclosure in the notes to accounts. So you need to, as auditors, you need to very carefully understand what was being discussed, and then you need to ask a question, and you need to also communicate that this is your query, and this is you need to have your audit procedures according to the information which you are getting from them. So your query is important. Listing and addressing queries or issues, it is very important to write it down. Nowadays, it is pretty simple. You can write an email. Some of the audit tools also facilitate that you put your queries on the cloud, and the client will provide the data on that cloud itself. So there is no exchange of mail happening. Your audit procedures can be done through that tool itself. So that's so these are latest technological improvements which we are seeing in our auditing profession. I would recommend that if you can try to use those tools, it will help
saving a lot of time and will bring in efficiency. Also, it will demonstrate that you were able to carry out the work, or you were able to carry out the audit procedures which are required as per the standards on auditing. It basically it serves as a record of questions, concerns, and discussions. Keeping the track record. Also, for regulatory compliances, financial reporting accuracy, and transparency, it is very important that who provided you the data, what date, and what was the authority with which you got that data, on which you are relying when you are carrying out your audit procedures. So fraud reporting of late has got a lot of attention under the Companies Act section 143(12), reporting of fraud by the auditors to the central government. Of late, there has been a lot of requirement. Now the regulator expect you to report frauds which have been identified by the company also. So 143(12) reporting has increased significantly in last few months, and I think it is prudent that we also look at 143(12) reporting in a careful manner. It applies to all the companies and especially the listed companies, 143(12) reporting, and there is a threshold also, and any fraud which is beyond that threshold has to be reported. But it's not only the Companies Act which requires you to report frauds. It's the SEBI LODR regulations also, where 4(2) subsection D mandates the board of directors to disclose to the stock exchange if there is any fraud by the company or on the company. So the requirement is that directors will have to report to the stock exchange. And there is no monetary threshold. I remember there was a question in the previous session. So in case there is a fraud, so there is no monetary threshold. So all disclosures have to be done by the directors to the stock exchange. Your SA 240, it gives you role of auditors in case of fraud reporting. You will have to report to the audit committee, and also as required by the regulatory framework, you will have to mention the nature, extent, and impact of the fraud. You will also have to attach supporting evidence and steps taken during the investigation. So please remember that it's not that everything you will keep reporting. You will have to provide the supporting evidence also. Like in one of the case where a large company, a listed company, and their auditors just mentioned that there was a fraud, so they are stepping out. So the company took the auditors to the court of law, saying that whatever they mentioned, it had an impact on the goodwill of the company. Also, you have to understand that this fraud reporting is very critical. Merely by giving your resignation as an auditor does not absolve you from the responsibility of reporting the fraud. That has come out in a recent case. So you need to remember that even if you are resigning, it doesn't mean that you should not report fraud. So this is SA 240 for you. I recommend that you please read this standard and make notes. Now we come to the reporting part. This is very important, and this is ultimate requirement from the auditors. This is what the deliverables of the auditors. So your audit report, if you are giving a clean report, unmodified report, standard on auditing 700. In case you are giving modified report, then SA 705. These standards on auditing provide formats and also provide the content of your audit reports. Your SA 706 gives you areas where you have to mention the emphasis of matter paragraph. But please remember that EOM paragraph is not an alternate to a qualification. So in case there is a transaction on which you have an opinion and you feel that the company has understated or overstated their profit or expenses or assets or liabilities, you have to mention it as a modification in the report, and you have to apply 705. Only the areas where you feel it is just drawing attention of the users of financial statement is sufficient and there's no impact on the numbers, then only you should give EOM paragraph. So SS 706 provides guidance on that. Then there are other matter paragraph also you will need to mention in your report. And SS 701 ask the auditors to provide the key audit matters. And it's not just mentioning that these are the key audit matters. You also have to demonstrate what procedures you carried out in that particular area. And since this is not a new requirement, you can always look into the previous published audit reports and you can see how the key audit matters were reported in various companies by the various auditors. There are other information. The standard on auditing 720 asks you to look into other information also, and you have to make an assessment whether that other information has an impact on the financial statements or not. In the audit report, you will also mention what are the responsibilities of the management and those charged with governance. What are your responsibilities as auditors? And then you also have to report on other legal and regulatory requirement. There is a requirement by companies auditors report order, which is popularly known as CARO report 2020. So there are a lot of specific questions which you need to answer, and you will need to give your opinions, and you will need to give some factual data in that CARO report. Just to give you an example, one of the questions says whether the property, plant and equipment or the land which has been shown as assets in the company, the title deed of the land is actually in the name of the company or not, and if not, whether it is in the name of promoters or their relatives, and if yes, then you will have to give the details. So these kind of information, which are required to be reported in CARO. Also give you another example, whether the physical inspection of property, plant and equipment or inventory was carried out by the management. Auditor will have to provide their comment that, whether this process of physical verification is, it's on a reasonable interval. Also, auditors are required to report whether there are internal financial controls, whether they are documented, they are existing, they are operating, and they are effective. So you need to give, as auditors, you need to give a report on internal financial controls over financial reportings. There are other controls also, but as of now, there is a specific report which is required to be done by the auditors, which will talk about IFCFR, internal financial controls over financial reporting. So probably, the companies, they will need to have those documentation, those risk control metrics. Every key process, they have to identify which are the risk involved in that particular process and sub-process. What are the controls which they have identified in order to mitigate those risks? And once this documentation is complete and it is in place, then management has to do the testing, whether the controls which have been mentioned there in the documentation, whether those controls are existing and effective and they are working effectively. And once the management has done that, then auditor will look into whether the management has carried out that testing or not. And auditor will also, on a sample basis, will carry out their own testing on these financial controls over financial reporting. So your report, is very important document. You need to be careful in drafting, and it has to be in accordance with the standards on auditing. Please remember that this is one piece of paper which has been seen by the stakeholders, which has been seen by the users of the financial statements. Whatever words you mention there, these words carry a lot of weight. And tomorrow you will be asked a question that why did you report it in this particular manner and why have you not qualified? In one of the recent order of NAFRA, the auditor had given a qualification, and NAFRA has reprimanded and said that this is a matter which is perhaps should have been taken very seriously. It's pervasive, all pervasive in nature, and there should have been a adverse report. Why only a qualification? So these are the matter of discussions which will happen when your reports are being scrutinized by the regulators. Also, the people who are investing in those companies, whether they are bankers or whether they are business partners or joint venture partners, they will look at these reports very carefully. And whatever words you have mentioned there, you need to be extremely careful. And you need to have a robust audit documentation before you write anything in that report. That is the crux of the auditing, that whatever you're writing, you need to have enough evidence to demonstrate that you carried out your audit procedures before arriving at that conclusion. Now, some of the key considerations when you are doing audit of listed companies, please remember that materiality plays a very important role. Some of the companies may be very large, may be very complex. You have to understand and look at your reporting very carefully, keeping in mind the materiality aspect. Of course, this additional information which was coming and pages of disclosures which were coming. Now there has been a change, and now only the material accounting policies, and so you need to be careful in deciding what is your materiality level. That is one area where subjectivity will come into play, and you as auditor will be asked a question, why this much materiality? So, and also sometimes we face a challenge, especially small and medium practitioners. The problem is not about the audit, problem is about the excessive audit. So you are doing 100% checking. You feel very confident that you are doing 100% checking of all the bills, all the revenue, all the expense, all the fixed asset additions. But is it required? You have to give an opinion, and you have to identify what is your materiality level, and that is going to impact. In some cases where the bank branch audits are being done by the auditors, even a small mistake is being highlighted as a qualification. But please remember, there is a concept of materiality. When you are talking to a large company, let's say a listed company where the turnover is in lakhs and crores, and you are pointing out a error which is a very small amount, probably you will have to understand that the users of financial statement, how much that information will be useful for them. In case you are doing listed company audit and you find that your scope is getting limited, you have to consider whether you want to give a qualification or you want to modify the report. There should not be any scope limitation when you are carrying out your audit procedures. The company may say that, okay, we do not have this data, or we cannot give you access because of the confidentiality issues. You will have to mention it out in your report. Then when you are doing audit of the listed companies, you have to ensure that Ind AS they are complied with. In case there are any modifications, they need to be substantiated with with the evidence, and also understand that in regulatory requirements, you need to be very carefully following the rules. Especially, for example, if you are doing audit of insurance company, there are specific instructions which are coming from IRDA or regulatory requirement. In case of bank audits, you're getting specific instructions from Reserve Bank of India. So please remember that you are an auditor and you're giving an opinion and you are giving your report based on requirement of the regulator. So in case the company or the bank as a whole has done a policy and you feel that although they have followed the policies which have been drafted and implemented by the bank or the large company, but these policies are against, they are not in consistency with the regulatory requirement, you will need to point it out. Your communication need to be clear. Your report should clearly communicate what is the nature and impact of identified issues. Transparent information should be provided. Many times you also write a letter of observation and provide a letter to the management. Your observations should be very clearly communicated to not only to those charged with governance, but also to the stakeholders in case required. Your documentation, your audit files, your work paper file, they need to be very robust. Your documentation, like I had mentioned earlier, if you are maintaining files in soft form, in MS Word, MS Excel, your files should be in order, and they should be stored in such a manner that nobody should be able to tamper those files, later on. Of late, there has been a discussion that whatever your audit work papers are, they need to be stored in cloud in a particular time limit. And whenever the regulators will ask, you will have to give them access to that saved, audit work paper file. By the time that requirement comes in, let us all, be prepared. And let us follow these requirement of audit documentation. Let us follow requirement of standards on auditing in such a manner that tomorrow when this will become applicable, there should not be any challenge, and they should all be complied with very easily. In the previous session, you had a discussion around audit trail reporting and backup. This has been discussed in quite detail. So I will not go into detailing of whatever is mentioned in clause G and H and J. And also there are some sections which are talking about this audit trail. This session will be available on the Institute portal, and you can always go back and listen to the requirements. And there are these 11G and other audit trail related sessions are being recorded, and they are available on the Institute website also. And when you're carrying out audit of the listed company, you need to understand that there is a checklist on standards on auditing which has been issued by the Institute. You can take help of this checklist. This is also available in the soft form, and it gives you very interesting and very simple manner idea about how to comply with the standards on auditing. Like for example, SA 200 requires gives you guidance on overall objective of the audits. So how you as auditor will need to conduct an audit in accordance with standards on auditing, how when you are doing audit of financial statements, ethical requirements are required to be met, your professional skepticism, every call which has been taken by the management, you need to look at it from professional skepticism point of view. There is a discussion, there is a detailed guidance on that. Then you have to apply your professional judgment when you are doing the audit, and sufficient and appropriate audit evidence have to be kept. Your audit risk need to be identified. This is mentioned in SA 200. Then SA 210 talks about agreeing the terms of audit engagements. This checklist, it gives you a template that how you can mention, how you can keep these papers in place. There has to be a client name, there can be a working paper reference, who prepared it, what was the period, what was the date when this document was prepared, and how this checklist has to be used, and then who reviewed it, what was the date, and then this checklist of the institute is proving to be quite handy when the auditors are they are helping the auditors in complying with the auditing standards. SA 230 in the same checklist, it talks about audit documentation. It should be sufficient enough to understand the size and complex of the entity, the nature of audit procedures, the audit procedures which have been performed, and risk of material misstatements. Then your audit documentation to include the audit program, the summary of significant matters, issue a memorandum, and letter of confirmation. So these standards on auditing need to be complied with. So this is my last slide where, when you are doing audit of a listed company, please remember what is your purpose of audit. Whether you are working as ears and eyes, if you are working as an auditor, what is your purpose? Whether you are working as a policeman, whether you are working as a watchdog, whether you are working as a consultant, whether you are working as a catalyst. Please remember, there are a lot of expectations, and expectations are from the stakeholders, from the regulators, from the society, and from the management as well. But most important is the expectation of the regulators. So you as auditors not only are required to do what is expected by the literature or standards on auditing, you also have to keep in mind that you probably will need to go a step further and carry out the audit in a manner which is not only complying with the auditing standards, but will also meet the requirements of the stakeholders. So your role as auditor is very important role. There are a lot of questions being asked. So keep your documentation in place when you are dealing with the listed companies. Please remember that the stakeholders are public at large. So public money is getting involved, and you are playing a very, very important role. Everybody looks at you as auditor, from a perspective of that these are the people who will work in a most professional manner, and they will bring out in case there is anything which has been, not properly recorded or being reported by the company. So I'll stop my presentation, and I hope the session was useful for you. I'll ask Ayush, in case there are any questions from the audience, I'll be happy to answer those questions.
Thank you so much, Praveen sir, for your time and your enlightenment to our audience. Definitely, we would love to hear from you next time and again. And our audience has certain questions, sir. So the first question is, sir, if we are auditing a parent company, which is a listed entity, and the subsidiary company auditor is different, both are both the auditors are different, and the subsidiary company is material and having 70% of the turnover of the consolidated group. Then, as a parent auditor, what all precautions and do we need to take, and do we need to be more precautious in that case as a parent company auditor?
So there are guidances. There is a guidance note on consolidating auditor. There is a requirement by the SEBI also that if you are signing up as auditor of the parent company, you have to take the responsibility of all the components also. If there is a 70% by the subsidiary, you will, and that has been audited by someone else, you will have to look at the work papers of those auditors, and wherever required, you can do additional procedures as well.
Got it. So one more question. Sir, please provide guidance on the material accounting policy as it is outlined in the MCA notification in March 2020.
I think Amit has opened up his camera and he spoke about this significant versus material. So Amit, would you like to address this issue?
I'm sorry, if someone can repeat the question.
Yes, sir. Sir, could you please provide the guidance on the material accounting policy as it is outlined in the MCA notification in March 2023?
Yeah, so basically, the intention. So basically, what is the background to this? The background is that what companies used to do was just copy paste copy paste the relevant paragraphs from the accounting standards and put it there. And it was just completely, photo of what was mentioned in the standards. So, so from the users of the financial statement, they were not getting the desired thing, what is actually impacting the financial statement. So accounting policies are fine, but how are they impacting the financial statements? That's where this distinction has come in now. Now they're saying that significant accounting policies is fine and you may not want to give it, but you give what is material. So what is material is that it should have a direct linkage with how the financial statements have been impacted. This is the background. And of course, there is a lot of flexibilities available also. You can still have accounting policies in the financial statements, but then the material accounting policies have to be clearly separated, distinguished, distinctly identified that these are the material accounting policies. These are material and these are significant. The example that I gave was, uh, let's say, the change in the discount rate. Now, this may have a material impact on the financial statement. That's what the stakeholders would want to know. And in fact, I was going through one of the commentaries. One of the learned personnel actually said that this is a very welcome step because this will, in fact, reduce the number of pages in the financial statements. So this is the background, and now, of course, the enough literature is available. One can take a call, but this is how it needs to be looked into.
Thank you, sir. Thank you for your guidance. Sir, one more question which our audience has put up. Sir, can we get some enlightenment on the concept of mainstream media?
Mainstream media.
Yes, sir.
Okay, I think Anilji, we will have a separate session on this media.
Right.
I will go to the next question.
Sir, one more question, which was almost coinciding with the previously asked. So, what are the corporate governance requirements considering the subsidiaries of the listed entities?
Yeah, this I've already answered.
Yes,
as
it was coinciding with the previous question. Right.
Yeah, yeah.
Yes.
So thank you very much, Ayush.
Thank you. Thank
Deepak ji, you are having any question? Deepak ji? Deepak ji, you are having any question?
It's not
Deepak
there.
ji, you are there?
Anil question नहीं है इसीलिए नहीं
Just one sir. Deepak ji, you are there or not?
His mic is mute, I guess.
It's fine. We can conclude.
So thank you so much. Now we come to an end. The questions we will receive later, I will forward to both the learned speakers, and then again we will forward the responses to the concerned member. So now we come to an end. Thank you so much on behalf of AASP of ICI. Thank you so much, Parveen sir. Thank you so much, Amit sir, for such a wonderful deliberation in this series of first webinar. And hats off to you. And from the core of my heart, thank you so much for sparing your time in spite of having jam-packed schedule during this audit committee meeting during this month, and you have given your consent, Parveen sir and Amit sir, apart from this very busy schedule. Once again, thank you so much from the core of my heart, sir, towards both of you. And also thanks towards both the moderators, Ayush ji and Deepak ji, for moderating this webinar. Thank you so much on behalf of AASP of ICI. I also extend my thanks to all the participants of today's webinar, and I request all the viewers to please register for your next second part of this series, which is going to be held on 9th of April from 4 to 6 p.m. And the topic for that would be CARO 2020. And similarly on 12th of April from 11 a.m. to 1 p.m. for Schedule 3 requirements. So I request all of you to please register for next two forthcoming webinars also. Thank you so much. Thank you.
Thank you.
Thank you, sir.
Thank you, sir. Namaste. Namaste. Namaste.